Well, good morning, everyone. I'm Dr. Laurie Davis, and you're listening to the Dr. Laurie Davis Show, and it's Tuesday. I love our Tuesday shows with my co host, Ramin Modiri. He's no longer a guest. After you've been here two or three times, Ramin, you're a co host.
All
You're not.
right.
So, welcome to the show today. If you're just joining us, be sure to tune in. We're broadcasting live on our Facebook page, Self Worth the Missing Link Superstars, our YouTube channel, Laurie Davis Show Host, and also, of course, on our network, E360 TV. So, welcome to the show, Ramin, again,
Thank
and
you.
thank you for being here.
Thank you so much. It's wonderful to be here.
Because we have a job to do today. We have an assignment we have to complete. And last week, and I took notes, it was really fun. Last week, Ramin shared 10 biases that we might be holding when it comes to our finances, investing, and all of the other things. So he has a total of 24. So if you want to see the first 10, go into the YouTube channel and check out last Tuesday's show, and they'll be there. And today, I'm pleased to turn the mic over to him so that he can share as many as we can get in within the next hour. So we just kind of banter back and forth, and Ramin discusses the financial. And usually, while he's talking, I'm connecting it to something on the personal level. So, um, in other aspects of our life. So, over to you, Ramin. Let's get this show on the road.
Oh, wonderful. Thank you very much, Dr. Laurie. As always, it's so great to be here, part of this show. Yes, it's interesting, like you mentioned, how our personal beliefs affect all other decisions, especially again when it comes to money and finances. And now we are mainly emphasizing on investing sides and the trading side. So last week we did 10, and I thought let's continue with that. In portfolio management and investment business, we call these behavior finance, and it just connects our emotional and again our belief system with our decision making. So today we're gonna do the next. I was gonna do 10, but I ended up with 14 more, so it comes out to 24, which is it's a lucky number for me. So here we go.
Yes.
Number 11 is called anchoring. And once we talk about anchoring, we anchor our beliefs to the earlier information that we receive, and we compare all the other decisions to the earliest information we got. I give you one example. For instance, we go to a car dealership, and then the salesperson takes us and shows us uh, the the car that it has all the things in it, with all the whistles, and then it's $100,000 car. You deserve this. It's a beautiful car, and then we use that as an anchor. So by the time we leave, we buy. Our budget was maybe 40 or 50. So when we get to the $50,000 car, we think this is a great bargain. Look, I started 100. I'm buying a $50,000 car. That's the one I wanted. So we make our decision based on that initial pricing. And it happens in stocks or in any investments. For instance, we see stock was $100 when we were thinking of buying it with no relevant information. If a stock is at $50, we think, oh my God, this is a bargain, without really doing a research why the stock or the investment has dropped 50%. So we base things on really irrational decision making, just based on a initial price. You see that also when you go shopping on the retailer store. The dress is $1,200, and then you find one for $300. You're so happy. Well, it's $300, but because your initial, again, anchoring was that $1,200, you feel like a winner because you got a $300, which could have been maybe $150 dress. Who knows? But that's called anchoring bias. So
Oh, wow.
yeah.
Your volume was just a little low there at the beginning, so just make sure you're nice and close to your mic
Okay.
there.
Awesome.
Well, actually, this leads me to share a bit of a fun story. I
Okay.
always share with my female clients that women were born with two extra chromosomes, And they go, oh, and I say, yes. And I have no scientific basis to make this claim, but here it is. 2 extra chromosomes. One's called guilt, and one is called on sale. Because if I, as a woman, see something that's on sale, even if I don't need it or want it, I get it because it's such a good price. So
Right.
I understand what you mean by anchoring, though. And then, of course, when you drop that price down, you feel like you're getting a bargain or a deal.
Correct.
And am I right in assuming that you end up still spending more than maybe you can afford, or overspending?
Well, right. Well, when it comes to choosing an investments, you think, oh, because the price is down, this is the bargain, like you just mentioned. But it could be really bad investments because if it's gone down $50 or 50%, there's a very good chance it's going to go down again another 20 or 30%. But we don't take the time to research and find out why. We base everything based on initial price. So
Oh, wow.
that's what becomes our anchor.
Oh,
Anchoring. So right.
my.
So let's go to number 12 in terms of
Okay.
time. The number 12 is a hindsight bias. And hindsight bias is when people claim, they say, well, I knew this is going to happen. Like, for instance, there's a crash. So
Okay.
let's say we had a financial crisis or we had the internet bubble. And you hear this a lot in the parties because it's a good conversation. And they say, oh, yeah, I was aware this real estate is going to crash. And it by talking about that, and they actually believe in that, it gives them the false sense of security, thinking that they're really new. There might be some hints, but majority of these people did not take any action. So when you don't take action, it really means nothing. But they feel good about this. They call it in the United States like a Monday morning quarterback. They analyze things, they know everything. Well, it's not about that. It's about really you should have taken action then, not just talk about stories. So we have these hindsight biases on the decisions that we make or we think we did. And it gives us, again, that whether it's the ego things, unfortunately, it tells us that we know more than we think we know. So, I mean, we think more than we actually know. So that's called hindsight bias. The number 13 is it's called endorsement bias. And what we mean, this happens a lot in the retirement planning, people who have like 401ks or some kind of a savings plan. And usually in those situations, you have a select group of funds available to you. So the employer says, well, you have these 20 funds, for instance. Because it comes from authority, comes from, let's say in this case, employer, people who are participating in that, they feel that, oh, they're endorsing this, so these must be really great funds. So I am going to go, and it's more of a authority. So because they know it, I'm going to follow that. So it must be good. Well, they don't realize, and again, this happens a lot in the retirement planning and pension plans, not the pension, like a 401k plans in the United States, is there's a lot of things behind the closed doors. There's a lot of marketing. Maybe one company was offering a lesser commissions or more commissions. So the employer made a decision not just on the validity of the funds, but other factors. But just because we as employee think that it's coming from them, we validate the idea, thinking, well, this is great. So we are doing really good investment decision. So that's called endorsement.
Okay. Well, I'd like to comment on the hindsight.
Yes, please.
What's
Sorry.
that? What's that old saying? Hindsight's 2020.
That's right.
Right. Because this just came up this morning in our 100 Shades of Entrepreneurship. And we did workshop number 51, bounce back ability. So how quickly can you bounce back from something? And we were talking about it's easy to look back. This came up, this very thing in other aspects. Looking back and realizing that there were lessons, maybe you have something really bad happen. And at the time, you are so entrenched in that, you cannot see the gifts or the talents or the lessons. But a year later, you'll look back and say, that was the best thing that ever happened to me because I didn't realize, whatever. And it's a year later and we can see the gifts. So that's kind of from the life side of things. So
Right.
I see what you're talking about there in in the hindsight. And also endorsement. We're always looking for endorsements because we believe it gives us credibility and it gives our work credibility. You know, like for example, if we had a big time celebrity as a client, everybody would want to be part of that. So, oh, hey, there's an idea for us, Ramin. We just need a celebrity on board. I just thought of two or three.
Right.
Okay.
Well, that's what, again, like you mentioned, that's a lot of sometimes the wrong decisions are happened because of that too. Because the celebrities, for instance, we had, a big, like in the cryptocurrency, a big scandal happened a few months ago, and largest celebrities were involved, and they lost money or they gotten paid. So we just that's what the commercials use these endorsements. So I'm just trying to say that doesn't mean when
Right.
it's on that, because they don't really have the sources to validate that. So number 14 is called choice supportive bias. Now what that means is, like, we as investors, when we choose something, then we feel positive about it. So because I chose it, so I put my money in it. Let's say I bought a stock. And what we do, we go around and tell the groups, our friends, to just make ourselves again bigger than we are, because we think we did a good job. So we trying to get them involved to show them how right we are. Oh, I bought this stock. Just watch it. It's gonna double. It's gonna be great. So again, it has no valid. Maybe we did some research, but we want to have that supportive group to tell us how great we are and what a good investments. Now, it could be right or it could be wrong, but we call that choice supportive bias. Some people do it in their private of their own, nobody knows, but a lot of people like to blow the horn and go out and just say, look, I did this. You got to see how wonderful it's going to be. So that's
Wow.
another bias. Yeah, it happens
Well,
in our decision makings too. So,
right. And I think that's in anything. We like to have support, and we want to know that people care and that people want the best for us. But we do have a live viewer this morning, so she put a comment up, and I'm just going to put her up. Sylvia Somerville, our good friend from Niagara Falls, Canada. So, hindsight involves all aspects of life, and it is true, especially in financial matters. We must be informed and do our research before investing.
nice.
Thank you, Sylvia. Thank you so much.
Very
Absolutely.
good. Right. Right.
And Sylvia has her own story, which hopefully you'll hear at some point too around that. Thanks, Sylvia. Great to have you here.
Very nice.
We all need to be supported no matter what decisions we make. And like you said, sometimes we have to do those things alone, and sometimes we have to, you know, pull in other people, get their opinion.
Right.
Yeah, for sure. Especially around money. Money is
Yes,
such an emotionally charged subject, isn't it?
it is.
Oh
Yeah.
man. Okay, over to you, number 15.
Number 15 is called information bias. And many analytical people are very much guilty of this. It's we seek more and more information to proceed or reject a choice. We look at the relevant, irrelevant. We do the Google search. We go talk to people who are, again, they're important, but some people, they don't even have any business in making that decision. And sometimes we call it analysis paralysis. We go do so much research and, again, information seeking that we end up missing the opportunity. So sometimes we have adequate information to make that decision, but because we delayed, because we want to make sure everything is in its place, that's called information bias, because we want as much information as possible, as I said, and that um, allows us to miss the opportunity in the financial decision. So that's called information bias. And
Well,
again,
I have a personal story on that one too. Not a personal
okay,
story, but an
okay,
example of that.
sure,
When we talk about all the different ways that we make decisions. We all have a system that we use to make decisions. We have people that are impulsive. We have people that need to sleep on it. We have
Right.
people who need to get the opinion of someone else in order to make the decision. And then the one you just talked about, the research. So I use the example of, maybe I just want to buy a blender. And I get online and I check Amazon and I check all the buying places where I could get a blender and the color and the price and the lifespan and blah, blah, blah. And 6 months later, I still don't have a blender. And I
Exactly.
needed one at least 4 times because I cook a lot. So I could use one every day. So
Correct.
6 months later, you don't have a blender. 6 months later, you don't have an investment.
Right.
Just
Exactly.
saying.
And the opportunities gone by. Yes, exactly. Good. All right. Number 16. We are moving along. Oh, that's good. So,
Good.
number
Yeah.
16 is called clustering bias. And what that means is we see patterns in the random events which are not really related, but we make that to support our decisions. I will give like very kind of a dramatic example. For instance, now let's say in some place there was a terrorist attack. Just use that as a name. And then we immediately go buy these defensive stocks, thinking that major things are going to happen. And we go we go really aggressively because we think, oh, this is it, which could be or could not be. So that was a random act. And then we just related this thinking that all the stocks are going to go up. So there is this, again, justifying in our mind what the decision we made, but also going aggressively with that, thinking that, again, it's the human being we talked last time about. This we call it as a gambling fallacy. We just have this idea of a short-term returns, and we want to make sure we get wealthy in the quickest way. So this is one of those that we immediately relate to, really not completely connected events to our decision. So, and then this is called clustering bias to
Mhm.
justify our decision based on that pattern.
Wow.
Yeah, it happens quite often, actually, believe it or not. So, yeah.
God, I just saw on the news, because we watch the American news, um, the latest jackpot, 900 million. That's like nearly $1 billion on a lottery ticket, isn't it?
Yeah,
Holy cow.
yeah,
Yeah. And then people say, well, you can't win if you don't buy a ticket.
that's right.
So then, you rush out, you buy a ticket along with, the 40 million people.
That's right.
All right. Number 17.
Number 17, already there. Good. This happens actually in all aspects of our lives, but it's called regret aversion bias. So, what I mean by that is, again, it happens in all aspects of our lives, but and then as an investor, we try not to make a decision or refuse to make a decision because of the fear that it's going to turn out to be wrong, and then I'm going to regret of making that decision. So we keep postponing making that investment decision, again, because back of our mind is that, oh, what if I was wrong, what if I'm going to regret it in the future. And I'm sure it happens in relationships, it happens in job, it happens in any decision we make. But it's specifically, again, this is a postponement and the delaying of the making decision, as far as because we don't want to be wrong and we don't want to regret it, and we miss a lot of opportunities because of that. So
Mhm. Well, Zig Ziglar, who's passed away now, but famous motivational speaker, he told a story of being on an airplane and he was sitting next to a guy. I've shared this before. And he had his wedding band on his right hand. And he said to the guy sitting next to him, he said, I noticed you've got a wedding band, but it's on the right hand there. Oh, he said, that's because I married the wrong woman. So I think he had some regrets But it was so, I remembered him sharing that story live. I was in
Okay.
the audience when he shared that, and I thought the place was going to fall apart. Everybody laughed so much, but that's basically what you're talking about. And, having those regrets and not being able to let ourselves off the hook if we do make a mistake. We're very good at punishing ourselves, right?
Yeah.
Yeah.
That's
Yeah.
so we avoid it basically.
That's
So
right.
no
Right.
decision.
Yes.
All right. We are at number 18. All right. So the number 18 is called outcome bias. And what that means is we put so much emphasis on the result of
Mhm.
things. And let's say we invest in stock or in investments and it did really good. And we feel really confident about ourselves. Although this could have been a fluke. So once we invest in something and we think that, boy, that was easy. Oh my God, I'm such a great stock picker. So what happens because of that fluke, we start day trading, we start using large sums of money because we have this the reason that, oh, my stock did really well, so I must be really good at it. So what happens? This happened again in 3 years ago after the COVID. With we call the meme stocks. All of a sudden, everybody got into buying options and stocks, and they thought such a easy. God, this making money is easy. I'm quitting my job. This trading is for me. And unfortunately, like anything else, life teaches us hard lessons. So basically, because of that, they are back to square one. But that's called outcome because we put all the emphasis on the result rather than the process. How did we get there? Because, a lot of timing is everything, but we just got lucky at that time. So this doesn't reflect on our really talents in a sense.
Mhm.
Gives us a false sense of security again. So that's called
Right.
outcome bias.
Right. Well, I believe a lot of people are attached to outcomes. They get really emotionally, physically, spiritually attached to the outcome
Right.
that they sometimes forget that there's a process to having that outcome. And instead of spending energy in the process, they spend the energy, fantasizing about the outcome. So I believe there's a balance there that we have to have in order to participate in the process and have the expected outcomes. And so, um, and if it doesn't work out, then my favorite word is next. Okay, next, the next community, the next person, the next
Right.
whatever adventure, right? So, yeah, excellent. Okay, number 19.
So number 19 is self-control bias. And again, that happens in a lot of aspects of our lives. Uh, but what it says is we don't want to act in our best interest in the long term. So a lot of times, for instance, people postpone making retirement planning decisions, putting funds for their future because they like to enjoy that moment. So it's a very short term or short sightedness. They look at just what I can use it for today. So they sacrifice putting funding or investing for the futures at the cost of, again, missing that opportunity. So they don't do, we call it like dollar cost averaging. Well, just put a little bit of money aside at a time. No, like we talked about sales and, so it comes to the self control. And there have been a lot of studies done. I'm sure you're familiar, the delayed gratification, for instance. You will see it from the childhood and what will be the success when people who are willing to delay that gratification and make a little sacrifice now for a much bigger reward in the future. And again, I've done obviously with a lot of retirement plan. I think people, obviously they're the part of not because of the financial um, insecurity in a sense of not having the funds. it was just a choice, and they decided to choose that immediate gratification rather than planning for the future. And that's called, again, self-control bias.
Yeah. I think you and I may have had a chat about this book. It was called The Marshmallow Theory. And they took a group of 5-year-olds and put them around a boardroom table, and they gave them each a marshmallow. And they said, you can eat the marshmallow now, or if you let it sit there for 5 minutes, you can get a second marshmallow.
Yeah.
And it was like through a process of elimination. So, a couple of the kids chomped down the marshmallow and they were dismissed. And then they asked again, okay, you've got 2 marshmallows. You can either eat them right away now, or if you wait another 5 minutes, we'll give you a third marshmallow. And it ended up that there were 2 kids left out of the group, I believe, something like that, very small number anyway, who would have sat there all day and let their marshmallows build up. And the research was all about, who would make a good entrepreneur, because as an entrepreneur, we have to be really good at delayed gratification. Yeah, we have to get really good with that. Otherwise, we'd be out of business in no time. So, yeah, thank you for that.
No,
Control.
following up on that is, there was a Stanford study done, and, they went back. So this was not marshmallow, it was very similar, and they did the cookies, and they went back and they looked at it like 20 years later, and they found out actually the kids that they had that delayed gratification, they were actually more successful entrepreneurs than the ones that immediately, which is very interesting.
Yeah,
there was a debate about that also, that some of the kids who ate them fast, they want to check to see maybe they didn't have breakfast or something, so it might have been more physical need, but generally that delayed gratification has contributed to people who are more successful in business.
Wow.
Yeah.
Cool.
Yeah.
All right. Number 20.
So the number 20, yeah. So it's we call it self-attribution bias, and it's an information processing bias, or we call it cognitive. So what it is, the investors, they credit themselves for all the right decisions that have been made, and then they blame the situations and the environment for all the wrong ones.
Oh.
So very selective memory, but also, again, it creates a false sense of security. So they are very good at blaming when things go wrong, and very good at taking credits when things go right. So they don't give credit. For instance, let's say they're an investment, it's a bull market, everybody's doing well. They say, oh, I made the right choice, nothing to do with the markets. Or they become very aggressive on doing things, but when things go wrong, they say, well, I had no control, the market crashed, so and so. Let's say a company's CEO did something wrong, or economy, the federal, it's all the fault of the government or central banks or all that. So they blame everything else, but that's called self-attribution. So, and unfortunately, what happens with that is life full of lessons. Once we do that, we are never willing to learn the lesson, because now we have a defensive mechanism, a weapon to, again, credit ourselves when things go right. But our defense mechanism, well, everybody suffered, that was fault of this. So unfortunately, this pattern behavior will continue, and we don't learn from that. But that's called self-attribution bias.
Well, that happened to us in my professional life as a school teacher. If it was like common knowledge, well, not that it was the truth, mind you, but if the kid did well, it's because they were really smart. And if they didn't do well, it's because they had a poor teacher. we used to put up with that crap all the time. Oh, he's doing really well. Yes, he's doing really well because he's so smart. And then the kid's not doing well, and they go, well, maybe we should shift him over to Mrs. So-and-so next door. Maybe he would do better with her, And then Sylvia has put up another comment, so we'll put it up. Absolutely, we need to make saving a priority and include saving in our budget. Instant gratification gives you what you want right now, but then you have nothing for tomorrow. Yeah, that's great. Yeah. Thank you, Sylvia, for being here. I love it when
Yeah,
there's
it's
someone
awesome.
here and they put comments up and then we can discuss them, or they're agreeing with us or whatever. So that's great. All right, number 21.
21. All right. So this one is interesting. It happens again in our retirement plans, and we call that 1/n diversification bias. And what I mean by that is, let's say you have a portfolio, you have a sum of money, and what you decide to do, let's say so much money, you just split it. Let's say you put a tenth of it in each category or each investment. So there's, let's say if it's 100,000, you put $10,000 in each stock. When it comes to retirement, for instance, you choose different funds and you just put equal amounts in each investments with no regards to the relationship of those investments to each other. So for instance, I can go and buy 10 stocks and 7 of them could be in technology or could be in economically sensitive stocks, cyclical stocks we call, something that, let's say autos, for instance, or construction. They're very much related to um, uh, economy. So what happens is, in reality, we haven't really diversified. We just put tenth of things in everything. And again, some of the investments, they have much more potential. Some of them have much more risk. So we just basically, it makes us feel good. We think that, oh, I put tenth of everything or 1/5 of everything. So if things go wrong, I'm covered because I'm diversified. If things go right, I'm going to do well. But again, we ignore a lot of times. This is just an easy way out of managing your portfolio. You just feel confident. It makes us feel comfortable because we think we are diversified, but it's really not. You've got to do some more investigation to make sure. Again, there's not everything is independent of each other. So make sure you do it in the correct way. So, but that's called 1/n diversification. As I mentioned, it happens a lot with the retirement and more about the long-term investing. So, um, again, the old saying is don't put all your eggs in one basket. It's true, but those baskets could be very similar baskets. So at the end of the day, those 10 baskets were only representing 2 baskets. So
Okay,
you
I
see what I'm
understand.
saying? So you're
Yeah.
not really, your risk could be still concentrated on one thing. So that's called
Right,
diversification risk of, again, equal amounts. So that's
right.
one. And,
Mhm.
number 22. And so the number 22, we call it, is cognitive dissonance bias.
Well,
And
you're gonna have to spell that second word.
yeah, the cognitive dissonance, and it happens in again in law also it happens. Dissonance is DISSONANCE, dissonance.
Oh, dissonance, okay.
Dissonance. So what that means, again, we say it in the law also, is we ignore as investors, what as a person, we are stuck in our own information. So any new information which comes, we just basically ignore it because we want to stick to our original decision, and it makes us feel good about that. So, for instance, because of the could be because of the psychological effects. Sometimes we don't make the right decisions. We were supposed to um, uh, would have been a good idea, for instance, sell an investments because of the tax losses, but we could have taken that as a deductions, but we avoid that. Or what we do, we when we are wrong, and instead of really cutting our losses because the new information came, let's say a company had a bad earnings, or something happened with the economy. Rather than doing that, there's something called we average down. We buy more of it because we still believing that our original decision was the right decision. So we say, oh, the market is wrong. We are right. So I'm going to go buy more of this. So that's called average down. So we are hoping, we know, well, it's going to come back. But unfortunately, a lot of money is lost because of that, is our stubbornness. And the other excuse or the reasoning we give ourselves is, oh, you know what, this time is different.
Oh,
This
yeah.
it happens in the relationships or bit. So we use that as excuse. This time is different because we are so stubborn, stuck to our original decision making, that we selectively ignore all the new information. And that happens a lot in portfolio management. Even professionals do that. That stubbornness, or whether it's the face, they don't want to lose their face, so they use this as an excuse. But it is called cognitive dissonance bias, which happens a lot in different aspects of our lives.
Yes, and that reminds me of an article that I read about, especially in education, in the school system, where a well-intentioned teacher or guidance counselor would say things like, well, you don't want to pursue playing the violin. You can't make a living doing that.
Mm-hmm.
Or you're going to write poetry. I'm using that because Sylvia's here. She's made money writing poetry. Um, you don't want to do that. It's like not quite exactly what you're talking about, but it's that stubbornness. Well, I'm going to play the violin anyway, even if I don't earn any money doing it
Mm-hmm.
or can't. But it's kind of like that. Is that close, or am I
Well, I
missing
mean,
it?
I think that's a positive side. No, this is more of a negative, that um, because we believe that decision we made was right, original, we selectively ignore any kind of a new information.
Right.
I use that in relationships again. Like the relationship you're in, even though you see things, but because you made that commitment and you think, well, you look at all the positive sides, oh, this is going to work out. This is going to work out. In
Mhm.
the meantime, you see all the signs, the things are happening, and you just ignore that. And
Yeah.
then you actually even become even more loving, or you just offer more gifts. And this isn't an investment. Again, I know I made a mistake, but I believe I didn't. So in order to correct that, I buy more of this mistake. So
Right.
and unfortunately, it happens a lot in trading, which is a very short-term investing. So all of a sudden, the market's going down. In order to erase my mistake, rather than getting out of this, okay, we talked about it last time, last episode, is rather than looking at it, okay, just cut your losses and get out of it. But because of that, we think that this new information, the market doesn't know it. So I'm going to buy more of this, because if it goes up, my God, now I bought it at lower price and it goes up, I'm going to make a lot more money. And
Right.
or not, 80% of the time, it doesn't happen. And you end up losing a lot more money. And that's such a difficult decision, or as far as just the human psychology goes, accepting that being wrong. So we kind of cover it up. But that is the Achilles heels for a lot of traders, that they're out of business because of this stubbornness and sticking to their original decision without being flexible and saying, well, what happened? What was the new information that the market reacted so drastically and going against me? So
Mhm. Mhm.
um, and it kind of is interesting. I put the last three. We got the 22, 23, and 24. They're very much related to each other. So I'll jump to number 23 again. It's not just in finance. We call it the ostrich effect bias, putting our heads in the sand. So
Yeah.
ignoring, again, willfully. This one is
Right.
willfully ignoring the dangers and all the related information is coming because it's our comfort zone, or again, the stubbornness we try to avoid. So it's very similar in some ways, but when we talk about cognitive dissonance, we really truly believed in that. And ostrich is more of a really ignoring and just don't want to hear about it. We don't want to hear about the bad news. We don't want to hear that things are not the way they seem. And it happens a lot, actually, again, in investments. And I'm going to connect that to the last one, number 24. We call it status quo bias, which we are comfortable in where we are. Again, you can see how those three are related. We don't like to make changes. So all of a sudden, you have a portfolio or different investments. You just don't like to make changes, so you stick around. And although again you see things are going against you, you come up with excuses. No, it will be okay. It will be okay. And I'm not gonna make change. This is who I am. This is what's I'm not gonna. It happens in technology, for instance. I'm not gonna get an iPhone. I'm not gonna get. I'm comfortable doing the old-fashioned way. It's so these three are very much related. It's the stubbornness, again, avoiding the danger in a way of ignoring it rather than avoiding it, in a sense. So, and these are the, again, culprits of a lot of big losses, and especially again in trading. When it's short-term, things are really move fast, and unfortunately we ignore that. And these are my 24 biases that go with the human. Again, it's our human nature, unfortunately, which translates to again shortcomings in investment decisions because of our belief systems and things we bring.
Right. Well, this whole idea of not wanting to make a change, that would not be me. I'm queen of change. But it was probably 5 years after I had left teaching, and I was in the neighborhood of the school, my last assignment. And I thought, oh, it's recess time. I think I'll just go in there and have a coffee because I still had lots of friends in there. And so I went in and I walked into the staff room, and everybody was sitting in the exact same chairs they were sitting in when I left. They all had the exact same hairdos, same old nubby sweater, and they hadn't done a thing to the staff room to brighten it up or change it or anything. And there's a perfect example of how easily we are programmed, and how when we get our mind set on something, and whether it's good for us or not, we stick it out. But I thought, wow, that could be me if I hadn't left. I went, oh my gosh. But we don't like change. We fear change.
We do. Yes.
Yeah, we do. The unknown, right?
Absolutely. That's
when we don't know the outcome. And you talked about that too. True. So let's make a few little announcements thank you so much, Ramin, for all of that information. I was just making a lot of connections as you were speaking to us, and I'm sure our listeners and viewers will feel the same way. So let's see, what have we got coming up? Well, you and we have put together a beautiful package. It's called 100 Shades of Prosperity. It's going to be hosted by you and I in the fall, and small groups of 6. There are 100 workshops in the area of finance. So if you're interested in getting that in order, please contact us and we'd be happy to give you some more information. And we're excited about it, and we already have people signing up. So that's a good thing. And thank you for that. Let's see. If you have a story, maybe I don't have it on my banner, but if you have a story that you'd like to share, on Mondays, we do our VIP show, which is Voices of Indigenous People. We did our first one yesterday for season 5, and we had the beautiful Diane LaFond as our guest. the first interim ombudsperson for healthcare in the province of Saskatchewan. She's the first person in Canada to have such a position. So that was yesterday. Tuesdays is always the vivacious, handsome Ramin Modiri with finance, because we have to have something to make it interesting, right? So, finance can be pretty boring to most of us. So I'm glad we're here making fun and having fun and helping people understand money in a much better way that they can be connected to becoming a trader, an investor, savings, owning their own home, all these things. And on Wednesday, tomorrow, I have Dr. Susie Mearswick coming on because Wednesday we take some aspect of wellness and we look at that. And on Thursday, we feature authors, celebrities, athletes, people who have stories of inspirational stories to offer to others, either in the form of their book or their career. And Dr. Susie's going to join me for that as well on Thursday, because she and I were together in a compilation book called It's About Showing Up and the Power is in the Asking. And we're going to promote that on Thursday. So we have a full week this week here on the Dr. Laurie Show. And also remember, we're streaming live right now on our Facebook page, Self-Worth the Missing Link Superstars, on our YouTube channel, Laurie Davis Show Host, and on our network, E360 TV. So please, the only thing we ask is that you go in and share the show. If you click a like, that doesn't help us much. But if you click a share, we have no idea where that show could land. And we've had our show land in some pretty special places. I see Sylvia has put up another comment, so let's put that up. The school story you told would never be you or me or Ramin. We are go-getters. We are ready for whatever is coming in the future. But yes, there are so many people who do not watch the news and refuse to have a computer, etc. You are helping very much. Thank you, Ramin and Laurie. Well, thank you, Sylvia, for being here. Your comments are always welcome. You're such a beautiful writer and knows how to put words together for sure. So thank you, Sylvia, for being here today. All right. We have about 6 minutes. So let's just have a little chat about if we were, with you. Let's talk about our project a little bit, because one of the things that Ramin and I are really passionate about, both of us, is helping our current and the next generation in the areas of health and wealth. And would you like to speak a little bit about how health and wealth are connected, Ramin?
Oh, absolutely. So, yes, it is. I go from the opposite side. When we have, for instance, financial difficulties, how it can affect our health, just the mental status, the stress, the anxiety. So just that little thing. On the other hand, if we have our mental health is not in a good place, how are we going to make financial decisions? How are we going to earn money? So it's funny how not only just the physical, but our emotional and mental health can affect our decision making when it comes to finances, as we are talking right now. And a lot of these biases we spoke about the psychology, it comes from not only our environment, but also our mental well-being. And obviously, again, also physically. And I don't put as much, I put more emphasis, especially when it comes to money, on more emotional and mental than just the physical. Because I know a lot of people who had the, unfortunately, maybe physically, they did not have, we call it the wealth side of things as far as physical side, but they're brilliant. They make good decisions. It's the emotional and mental side, which is really is the obstacle for our success. And that's what we really want to work on. And the program that, for instance, we have put together really takes care of all aspects of well-being, not only financially, but it comes from a well-being internally as who we are. And the decision making that we do, it all relates to our upbringing, our environments, our belief system. And unfortunately, what happens, Dr. Laurie, is a lot of people, what they do, they go on YouTube, for instance, or they go take a class, one class, or read a book, and the emphasis is specifically just on mechanics of things. They think because they learn one technique, or it's going to make them a doctor, for instance, or they can heal everyone. They don't realize, well, there's a price to pay. We got to have the experience. We have to learn, but also understanding who we are is the biggest factor. And if we don't know where we are coming from, it's going to be very difficult to know where we are going. So, the what we are doing, again, working in the both aspects, finding out the roots of our belief system, the when we just talk about the biases, where these biases come as far as making us to make the decisions, but also it gives us the strength, believing that we are deserving. We should be wealthy. We don't have to sabotage ourselves when we have a success. So we have really combined the mechanical side of things with the, again, emotional and spiritual, and I would say even and mental side of things. And that's the key for success. And that's what I'm very proud of this project. I think it's, again, like you correctly mentioned, is the wealth and health, or I would say health leading to wealth in a way. And, that that's how they're closely very much related. So
Exactly. And I don't think we can actually have one without the other. So we came up with 100 workshops. I contributed 50. Ramin contributed 50. His are all in the mechanical, technical side of finance, how to work with your money. And then mine are all about that whole self-worth component. And the other night I sat down and I went, okay, how old was I when I had my first business? I was 12. So that means, 60 some years. And then I thought, how old was Ramin when he came to America? He was a young man at 16. And you know what? We have, in those two situations, we have over 100 years of experience to share. How cool is that? I just think that's very cool. And I'm going to brag about that. I really am, because I think that just speaks volumes about what we can bring to the table and how many people we can help, and how we can affect change for people in their personal and professional life. So I'm very passionate and excited about our project, and we're going to move forward on that. Well, we are moving forward. We've already started. So, all right. Well, I think our time is just about up. So thanks again, Ramin, for all of your wisdom and your kindness. And we'll see you next week. And I can't wait to hear from you what you're going to talk about next week. And I'm just here to provide maybe some of the humor and the funny stories that I'm connecting to as you're sharing. And it just seems so weird because you're talking about finance, and I'm thinking, well, that happened over here, and it wasn't about money at all. But like you said, it's more of a holistic approach that we're taking in terms of our financial education. So thank you for that, for being open to that. Even, a lot of being, pardon the expression, bean counters. Wouldn't even consider thinking that there was a soft side to finance, but I'm pretty sure the smart ones do. So I'm glad about that, to have you here.
thank you.
Okay, well, we'll say goodbye to everybody. Thank you, Sylvia, for being here and participating in our show today. And tomorrow, Dr. Susie Merswick for Wednesday Wellness. Okay, bye for now.
Bye-bye. Thank you.